Hey guys, welcome to another episode of Wave. Continuing our series on Luna and the stable coins, I thought we should really get into trying to figure out what are stable coins exactly, right? What are the types, and is there a real gem in here? Although Terra has crashed, more than 99% has wiped out investor wealth, but the concept still holds a lot of value. So let's see if there is a real gem in here that you guys can look at as a future investment. Now, I came across this report, that talks about different kinds of stablecoins, and I thought it's better to walk you guys through it. Uh, so, the stablecoin market cap has grown a lot. As of March of this year, I guess it was about $180 billion, right? So, why are stablecoins important? It's important because Satoshi imagined Bitcoin to be an electronic peer-to-peer cash system. Right? It was a cash that was, or a currency that was meant to be outside of government control. Right? It was a stateless currency, but the volatility is so high that if you had to pay for, let's say, a burger at McDonald's, right? You would think twice because one, the fee that you might pay for the transaction is very high, but more than that, you're more likely to benefit if you're just holding on to Bitcoin because the price is trending upwards. And as a buyer, as a seller, McDonald's or any organization that is willing to accept it might also think twice because if they don't sell it instantly and if there is a price drop, their money or their capital is sort of locked in for a while, right? So this has a cascading effect and affects payments. Uh, Bitcoin or any mainstream cryptocurrency cannot be used as a currency, and stable coins came into place to solve this precise problem, right? If so, all of us are used to trading in or buying for everyday items with our local currency. It could be the dollar, it could be the rupees, it could be euros. So whatever it is in your region, that's what we are used to. Right? So stable coins came up with a way to peg a token to a dollar or any of the other currencies, and hence enable people to make transactions very easily. Right? Now, stable coins are actually of three types. Right? If you look at this triangle of sorts here, stable coins are actually of three types: non-collateralized, fiat collateralized, and crypto collateralized. Right? The difference between them is over here. Now, if you see between non-collateralized and crypto collateralized, these two are decentralized, whereas fiat collateralized is not decentralized. Right now, fiat collateralized and crypto collateralized are collateralized, whereas the non-collateralized one does not have anything backing it. And fiat collateralized and non-collateralized are capital efficient compared to the crypto collateralized, which you'll see when we go into the depth of explanations on each of them. So, what is a fiat collateralized? A fiat collateralized stablecoin is like USDC or USDT or BUSD, which is backed by cash or cash equivalents. So if they are going to mint, let's say 100 USD, so they will have 100 cash or cash equivalents as collateral, and only then mint these 100 USDT. Sorry. So broadly, there are three major ones in this: USDC, USDT. USDT is the largest of the lot. I think it almost has about 50% or 45% market share. But here is a big problem. There is a very shady history to USDT compared to the other two in terms of audits and in terms of assurance that they actually have the amount of dollars or to back the number of tokens that they're issuing. USDT is not very forthcoming about it, and hence there's a very shady history, and it has a very large market cap. It has a very large market share. So, this is a huge risk. Right? Imagine 45% could just blow up overnight if there's a bank run. If somebody figures out that USDT does not actually have $80 billion worth of USD sitting somewhere. With BUSD and with BUSD, it is not so. Then there is something called crypto collateralized. Crypto collateralized is where you have to deposit some crypto, and they will give you DAI, like which happens to be one of the examples. They will give you DAI, which is pegged to $1. So you have to, but the catch here is you have to deposit let's say in Maker DAI, you have to deposit up approximately 1.5 times the amount you want to as collateral for what you want USD. For instance, if you want 100 US, 100 DAI, which is pegged to $1, then you might have to deposit a collateral worth about 150%. Right? This is what they take so that in case the value ever dips below the 150% threshold, there can be a forced liquidation, and DAI can maintain that stability of $1. So how do you get back your collateral? When you are done using your DAI for whatever purpose you are using it for, you can go and deposit back along with the stability fees, and then you get your collateral back. Now this collateral could be Ethereum. I think they have gone on to add many more, many more tokens, and including real world assets as collateral. Now there are non-collateralized ones as well, like Terra. So the logic here was simple. For more USD to be created, you had to burn Luna, and for USD to be reduced from the market, you had to generate more Luna. Right? And we saw Terra crash extremely badly last week. Their whole systems were not working. It's still so uncertain. Investor wealth is completely wiped out. Right? So I don't think people are trusting non-collateralized ones so much. But let's look at what actually happened, in terms of usage. Now, Tether used to be huge, but it has got cannibalized over a period of time. If you look at stablecoin active addresses, right, from May 2021 to Jan 2022, if you look at the trend line, it has continuously increased. So there are more and more people who are getting into the DeFi space, who are getting into, for whatever purpose they need stable coins, and hence they are starting to use this. And there's another interesting graph here that I wanted to show you. If you look at the stablecoin addresses with less than or equal to $10, which are small value transactions, these addresses have grown almost exponentially. Right? Just in like 2 years, it has grown from less than probably a million to over 10 million. That's phenomenal increase. That means more and more smaller users are getting into it, and also smaller use cases are being considered, which was anyway the original requirement of something of a stable coin, right? That you could pay for coffee with it. Now there is another interesting graph here, which probably will give you, yeah, here it is. So if you look at the different tokens that were issued in the last few years, the BUSD, USDC, and so on, look at their growth rates, right? 400%, 323%. Their growth rates have been phenomenal, and except probably HUSD here, because the Chinese have cracked down on their local exchanges, and hence it's in the negative. But otherwise, broadly, all of them have had humongous growth rates. And if you look at the market share, now here is where I think we'll find our gem. Right? Among the three, you have collateralized ones, you have non-collateralized ones, and you have a crypto collateralized one. So you have USDT, USDC, BUSD, UST DAI, and 10 others. UST was roughly 10 or 10.6% in terms of market share, which is completely wiped out today, and I expect that to crash to near zeros. Tether, of course, is cornering the market, but there is DAI here, probably around 8 or 9% market share, which is which is a great crypto collateralized token, which is decentralized, right? USDT, USDC, BUSD, they're not decentralized. Whereas DAI is the only decentralized token that is still has a significant market share, and I feel DAI has a great chance to blow up. Right? Why am I saying this? Because there is a huge risk in USDT. Right? We saw that the USDT has a shady history, and if there's a bank run on USDT, then the whole fiat-backed currencies will be shaky. People will not really trust in them, uh, and anyway, the purists were always for crypto-backed tokens, something that is decentralized, and hence DAI has a higher chance of survival in all this. If you look at the price of DAI, or Maker rather, Maker is the token behind it. Today it is around $1,500. Market cap's around $1.3 billion. At its peak, I think it was close to about $5 billion. So still a discount, about more than a 70% discount from where the peak of Maker was. Now the markets are down and hence it is significantly reduced. But the market for this is almost $180 billion. Right? There is a huge use case for stable coins, and one or many of these tokens will definitely continue to serve it. And I would take my bet on a decentralized crypto collateralized token over anything else. And I feel Maker has the best chance to be that. And looking at Maker's meager market share of 1.3 billion, it can significantly go up to maybe 50x or even 100x from here. Right? This is a gem. This is a real gem that in the making. If all goes well and nothing crazy happens like what happened to Terra. Do your own research on this. We'll try to come up with another segment exclusively on Maker, trying to do an analysis on it to see how good they really are. But going by just the charts and the competitors, I personally feel that Maker has an amazing future ahead. This could be that 50 or 100x gem that all of us must have in our portfolio. Thank you so much. This was just educational content. Hope you liked it. Like and subscribe our Wave channel. You can also check out wave33.club. Stay tuned for more episodes, especially the one on the analysis of Maker.